Hi everyone, this is Dave Mantell with Stabler Wealth Management. Thank you for joining us for our Spring 2025 Economic and Market Update. It has been a very eventful start to the year that might be a bit of an understatement, and a lot has happened. So excited to share with you what we're currently seeing in the markets, as well as our outlook going forward for the remainder of 2025. As we do these presentations, we hold the view that knowledge is power. And essentially, the more informed our clients are on what's happening, how it impacts their portfolio, how they're positioned to weather these scenarios, the better the chance of success in getting through these, not only from a financial perspective, but from a peace of mind, sleeping well at night perspective as well. So we will absolutely keep these updates coming and keep you informed of our read of the market and how we see that impacting you currently as well as going forward. With that, let's start with a recap of the first quarter of 2025. The first quarter was absolutely a bumpy quarter. As we've seen the inauguration of President Trump as president, a lot of the various policies began to roll out. And with that, a lot of change happened in the economy, which has created the markets a lot to digest and understand. When we look at the first quarter, so January through March of 2025, the S&P 500 was down nearly 5% for the quarter, and the Dow was down a little bit more than 1%. While a down quarter, this was before the fireworks started really going off with many of the tariff headlines that subsequently occurred in early April. But nonetheless, we did hit some turbulence and bumps right off the bat as we jumped a month or two into quarter one. That market volatility has continued on until April. As you look at the current chart, this shows the S&P 500's path in the month of April. You could see after the tariff announcement on April 2nd, the stock market took a swift decline, dropping dramatically over a couple of days. From that point, when it was announced that we'd have a 90-day negotiation period for the tariffs before they took place, the stock market then went through a very historic increase in a short amount of time too. And since then, we've continued to see a lot of bumps through the following weeks of the month as the market and the economy continue to try to digest all the information that's happening out there. As we look back at April, it's been really fascinating where we've seen, as it played out here, that the most volatile days, so the bad days, tend to come close in combination with the very good days as well. And April was an example of this, where on April 4th, the stock market, the S&P 500, dropped 6% in one day and nearly 10% over 2 days with that back-to-back pullback that we saw. So these were some of the worst days going back to 1990. On the flip side, on April 9th, when we got the negotiation period announcement and the extension until tariffs went into place, the stock market rebounded substantially, and we saw the S&P 500 go up 9.5%, so nearly 10% in one day. This was the third best stock market day going back to World War II, and a massive increase in the markets. And so as you can see, there's been a lot of volatility trying to digest what's happening, and that doesn't mean just things going down. When we see volatility, that can mean volatile up days as well. And you get a lot of back and forth and churning that tends to occur during these periods of time. While most of the media focuses on the S&P 500, the Dow, the NASDAQ, the reality is in a balanced portfolio, there's a lot of other investment classes that are utilized as well. And amazingly this year, many folks are surprised to see that many of these other asset classes have done really well. As you can see on this chart representing the first quarter of 2025, while U.S. stocks are down substantially, international stocks had a really strong start to the year, and that's continued into April, where both international equity, so developed countries, as well as emerging equity, so emerging stocks, were both solidly positive through the first quarter as well as year to date. On top of international, we've seen real assets perform very well. Bonds have done a good job so far this year. And so a balanced portfolio in many cases may be even or slightly positive this year, despite all the ups and downs and volatility around the US stock names. So it has absolutely paid off, a bit similar to 2022, having a diverse portfolio to weather these periods of volatility that we've seen. Looking at a couple other headlines outside of stock market performance, a few key indicators that we really keep an eye on. The first of which is inflation. As we all recall, back in 2022, we saw massive inflation coming out of the COVID period, as inflation levels reached nearly 10% year-over-year increases, the most we'd seen since the 1970s, 1980s. Since then, we've seen continued strong progress of inflation, with the most recent March 2025 reading showing only a 2.4% increase. That is very close to the Fed's target of 2%. When you get under the hood, there's different variables. You have core inflation. We've seen shelter be pretty sticky as well. But nonetheless, this is great progress from where we stood even 12, 18 months ago, and gives the Fed a lot of flexibility to cut interest rates, stimulate the economy if we did see a pronounced slowdown. So this is a big deal that allows the Fed and really the overall government to utilize their full toolkit potentially. I will note, with all the tariff uncertainty, tariffs can absolutely have an impact on inflation. And so that's something that Powell has noted, the Fed chair, stating that there are uncertainties still. And as the economy's been holding up pretty well, they've been very slow in terms of lowering interest rates. As noted there, even with inflation really moderating, we've seen interest rates hold at a pretty steady level. And what we can see here is the federal funds target rate. So this is the short-term rate that the Fed sets. And after a couple cuts in the second half of 2024, through January and the March meetings, the Fed has not cut rates yet for 2025. There's still a general expectation that we will see a couple rate cuts, but as I noted, the Fed's in a little bit of a wait and see mode to see, do tariffs spark inflation? How's the economy hold on? As there's so many different variables at play. But there is some room undoubtedly for the Fed to cut rates if the economy, in their view, is in need of some stimulating. And so that is a really solid place to be, and at quite a healthy interest rate level. I do want to note that while interest rates are a tad higher than we've seen over the past couple of decades, having the Fed funds rate at a 4 to 4.5% level is a bit higher than long-term averages, but not too far off from normal. And so, the view is ideally you want a normal scenario. You want normal interest rates, normal inflation, normal spending, normal deficits, things of that nature. And so with that in mind, while the Fed does have some room to cut rates, they likely will hold off on a magnified cut down to 0%, for example, after we've seen in some past stress periods, unless it was really necessary. They'll likely more slow play it and do a cut here and a cut there. So as a result of interest rates holding steady, we've seen bond yields also hold steady. Because remember, bonds are essentially loans. So when you own a bond, you're earning an interest rate, which is largely in sync or correlated to the Fed funds rate, depending on what type of bond investment it is. And you receive that yield throughout the life of the bond. And so while there's a lot of angst about higher rates causing mortgages to be higher, costs more for businesses to borrow, on the flip side, for retirees and bond investors, we continue to see really attractive interest rate yields on bond investments. And so as you can see on this chart, as of the end of the first quarter of 2025, bond yields are higher than they were a year ago, and a bit off of its highs from the start of the year, but largely in line. I will note that while bonds have performed well overall this year and the stock market's been turbulent, it's an important component to portfolios, as we noted, bond yields. There's been a view, as this is one to watch, where early in the early weeks and months of 2025, we saw interest rates, so longer term interest rates, start to trend down. During the turbulence in April, we saw rates start to go back up again. It's mellowed down a bit since then, but I do think it's a reasonable view that interest rates likely will be at a similar level, more or less, in the months ahead. And even if the Fed does cut rates, that doesn't necessarily mean long-term rates will reduce that much. So this is an area that we're watching and want to continue to be opportunistic on as we think of the bond investments for our clients. So now that we've laid a bit of a ground work and framework in terms of where the markets and the economy has sit so far this year, it's important to note that with the new administration and the recent tariff announcements, there is a lot going on and a lot of uncertainty, and that tends to lead to volatility. And the new administration has definitely implemented a lot of policies, some of which may be viewed as quite fast and furious. And as a result, that has created some uncertainty and been unsettling for the market. When we look at the policies, the one that has really got folks and businesses most up in arms is the tariff conversation. And so a good starting point is to go over what a tariff is exactly. So tariffs are not a new novel thing. These have been around and used by many countries, including the United States, for hundreds of years, if not more. And a tariff is essentially a tax on goods that are imported or exported between countries. And hence the name tax on goods, this is a type of tax. So when tariffs are applied, that creates a bit of a friction, and that additional tax or cost will be covered somewhere. It could be covered by the exporting company, the importing company, the end consumer, but that tax or cost is essentially spread out, and therefore creates a view that that could be inflationary, as many of these businesses will increase the cost of the goods they're selling to account for the tax that's being applied in the form of a tariff. And so the way that tariffs work is that companies that import foreign goods, again, pay that tariff to the government, and then in turn, those companies may adjust their pricing accordingly. That brings a question on why are tariffs used? Why are we running into this? And there are many reasons. Tariffs can be used to protect domestic industries and jobs. There could be a view that certain industries, through practices, whether fair or unfair, are putting certain companies, employers, employees at a disadvantage. So that can be used to try to make it more expensive for external goods, providing an edge to goods that are manufactured here. In addition to that, tariffs can be used to reduce dependencies on other countries. For example, security risks. More recently, whether it's your computer, your phone, your car, your washing machine, everything's run with technology now. And those utilize what are called chips as a key component of that. And nearly all the chips being created are coming from a company in Taiwan currently, which sits about 90 miles away from China, right? So that could be viewed as a security risk and a reason to try to bring some chip creation back onto U.S. Territory to control that process. The same thing can be used for medications, pharmaceutical products, and protecting, especially as we have more recently seen an escalation of conflict between various countries, the U.S. between China, Ukraine, Russia, various countries. That could be viewed as a protectionist view as well. And lastly, it could be used, and this seems to be what President Trump's going for as a negotiation tactic. Beyond tariffs, countries have many other levers they can use, whether it's managing the cost of their or value of their currency, right? When a country's currency is cheaper, other countries can buy more of their goods, for example. And so there's a lot of different levels here. But nonetheless, at the end of the day, a tariff acts as a tax. It acts as a friction. And it could also be a negative if that creates friction between different trade partners as well. So essentially, with everything going on the tariff front, it's resulted in a lot of uncertainty. And that's really what's resulted in the recent market turbulence that we've seen. So when we look at the tariffs and global trade wars, as we just talked about what tariffs mean, the new administration has proposed tariffs that have become a nightly news agenda as of late. And as President Trump began getting into the specifics of what those tariffs looked at, that's when we saw the global equity stock markets retreat in a quick and alarming way. It is worth noting when Trump started announcing the tariffs, he began talking about reciprocal tariffs, where we're going to tariff a country the same rate they're tariffing us. And as a result of that, the initial market reaction was actually positive. It's when the board came out and he started going line by line in terms of the additional tariffs that be applied to countries, where we saw the stock market really retreat. Likewise, when Trump then in a few days later mentioned that we're going to extend the negotiation window, the market came back, right? And so there's a lot of uncertainty right now, which is driving that volatility. And nobody knows the specifics of what that's going to look like, where we're going to land. And so the main thing is that we want to remain committed and keep a watchful eye on the tariffs and the effects on our clients' investment portfolios, and make sure we continue to be positioned in a way where we could handle different volatility that comes. Looking at a couple tariff charts that we find of interest. So one, as noted, tariffs have been around for centuries and is not a new thing. As we saw income taxes gain favor following the Great Depressionary period in the 1930s, 1940s, tariffs became a lesser tax tool by the government, and in the way of income taxes that became the paramount utilization there. And so as you can see, going back to the 1700s, 1800s, tariffs were a main revenue generator for the government. And we've seen a flip in the past 100 years or so where tariffs have taken more of a backseat. When the administration brings up reciprocal tariffs, this is what they're referencing there. So the U.S. Historically has had a very low tariff rate with their partners on goods that we're importing. So you can see the effective average tariff rate in the U.S. historically has been a bit over 3%. When you look at other trade partners, it varies country to country, but India's average tariff rate is 17%. China's 7.5%. And so this is the whole concept of reciprocal tariffs, where over the years, we have seen tariffs inflate in other countries. Many of this is post-war activity as we're helping build other countries up. And those tariff rates have tended to kind of stick a bit over the years. And as a result, we do have a much lower tariff than many other countries are applying to us as well as other trading partners. So while this tariff talk has been very unsettling and a massive unknown out there, it is a good reminder that we did see a high level of tariffs between the US and China during Trump's first term. And as you can see, at the same time, it was a very volatile response to that. And then as things settled in and we had clarity where those tariffs would land, the stock market did rebound strongly. So in the first year of that 2018 term, you can see the stock market was down solidly as we had a bunch of back and forth and tension with China on the tariffs that were being put into place. As we moved to 2019, that was a very strong stock market year as we saw some more certainty in where we landed on that tariff negotiation, and we're able to, again, have a better view for companies, businesses, individuals, where things will be going from there. And so we'll see what happens as we go into the 2025, 2026, 2027. But it is a good reminder that even going back to the first Trump term, we did have tariff tensions. The stock market was unsettled over it. But as the term settled in, the stock market did gain its footing. So hopefully it'll be the same case this time around. So that all brings up, with all this tariff talk, what does this mean for the stock market? What does this mean for our portfolio? And that's when we dive into a bit of a perspective in that regard. So the first thing to note is that when we look at the stock market in total, optimism is not high. We're going through one of the most pessimistic periods that we've seen historically. And so as you look at this chart here on the left, you could see in 2025, we've already logged some of the most bearish, so most negatively sentiment periods in history as long as this has been tracked. And this is comparable to levels during the COVID crisis during 2008. And so it's very rare where we're running into folks or you're seeing folks on the news that are positive about what's happening. And by the way, this chart is through first quarter of 2025, including April, where we really saw the turbulence settle in on the tariff talk. We've hit an even higher negative sentiment level of 62%, which is the third highest of all time. So what this means is typically when people are freaked out, people are panicked, the stock market is not overly optimistic. A lot of panic sellers have already sold out. People have already jettisoned from the market. And historically, that's set up really well for the periods that follow. On the right side of his chart, you could see if you look at the top 10 bearish, so negative sentiment periods, over the next 3 months, the stock market tended to be positive, up about 5.9% on average from an annualized basis. What's even more positive is as you go a year out from that negative sentiment period, the stock market has historically performed very well, averaging 25% performance in those instances. And amazingly, when people are overly optimistic and we see very bullish sentiment, as you can see on the right side of that right chart, that tends to bode negatively for stock market performance. So we'll see how it goes this time around. But again, the fact that there's a lot of negativity in the market, a lot of sellers have sold, does tend to set up well for the prospects. With that in mind also, it's a good remember that when the market pullbacks, things are going on sale. And while it's really uncomfortable in the moment, these offer some of the best opportunities to invest as you're able to get things at discounted pricing. And so as we see here, on the left side, the light blue, these show market declines of at least 15% going back historically. So these are more significant corrections. By the way, with the recent tariff turbulence that we've seen, the S&P 500 dropped 20% temporarily from high to low. As I noted, it's rebound solidly since. So that would fit into this chart here. On the right side, the dark blue, that shows the 12-month return after the steep market decline. And you can see across the board, it's been solidly positive following these decline periods. So again, while it's not fun going through these periods of volatility, many times it doesn't necessarily change the prospects of a lot of these high quality companies, and you're able to find things that are on sale or find some good deals. So it does tend to point to attractive buying opportunities. With that, when we mention that chart, many times folks we talk to say, well, this time feels different, right? We haven't seen this type of tariff announcement. There's massive uncertainty. This could change the whole world order, the way trading is done. And so with that, our response tends to be, you're right, this time is different, but this time is always different. What this chart shows is this outlines some of the most dramatic growth scares we've seen over time. And examples are Black Monday, stock market dropped over 20% in one day. The tech bubble crash in the early 2000s, the 2008 crash, COVID sell-off. So these are not your normal run-of-the-mill corrections, right? These are the big ones. And what's interesting is when you look at that period of pullback, so those are the orange bars going down, again, when you look at the next 12 months after that pullback, across the board, we've seen really strong rebounds, strong returns. And a lot of times, once you see a 20% pullback in the market, even scenarios where it goes down further, a lot of the damage has been done. And again, that's a time to really look at, hey, do we see buying opportunities here? Especially when you have a balanced portfolio that's designed to weather periods like this, which is what we strive to do for our clients. So again, this time is different, but we've been through a lot of periods of world wars, massive taxes, inflation, deflation that have also been different, and the tenets of investing remain. And so at the end of the day, volatility is a price of admission for getting good stock market returns over time. And the name of the game is having a balanced portfolio that allows your growth investments to grow and weather these periods. This chart here shows bear markets, so down markets are normal. We tend to have every one of them every 6 or 7 years or so, as you can see with the magenta red lines down below. And we're going to have more of them. As we're running different stress test scenarios for clients, looking at scenarios, we are expecting to see bear markets. It's going to happen. Everyone has a bit of a different flavor, but again, these are normal parts of investing. The blue, as you can see, shows the bull markets, the positive periods. And as you can see, they're much more pronounced, tend to act a lot longer than the bear markets, and tend to get much more gains. And so to get those nice blue gains over time, the price of admission is having a plan to weather through the red. And again, these are, while the current situation is always uncomfortable, it is not uncommon. And so again, this shows that downturns are a normal part of the investment experience and part of getting those long-term results that the stock market provides. So during uncomfortable, unsettling times like this, the main key is to focus on what you control. Control the controllables. Have the right amount of risks for your situation. Minimize taxes. Have a income withdrawal plan. These are things that we can control and allow us to get through these periods. I'll also note, as we go through stretches like this, the media grabs onto it and magnifies it. It's grabbing eyeballs. It's like watching a car crash. And so for a lot of our clients, we found that minimizing the news and media exposure during these uncertain times allows you to help take the emotion out of it and stay on your well-devised plan. Because again, as shown, at the end of the day, stock market, equities, or long-term investments, we have total confidence for them to get the job done and get the returns needed over that long time horizon and period of time. But in the short term, as Warren Buffett famously put, the stock market is a voting machine. It's going to change day to day based on the newest headline, what the recent votes are. Over longer periods, 5, 7, 10 years, it's a weighing machine. And this is where we can more rely on it to get those long-term returns. My last note I'm going to put in is we've seen a really volatile start to the year, but as noted, in a balanced portfolio, clients are hanging in there really well. It's really hasn't been too bad. And on top of that, I want to note we're coming off 2 huge stock market years in 2024 and 2023. And so even with the recent volatility and a bit of a pullback, proceed with caution. The stock market prices still remain modestly elevated in our view when you look at it from a historical perspective. They were quite elevated at the start of the year. It looks a little bit better now. And, again, this isn't to say the stock market will do poorly over the coming years. But again, it's going to be more prone to volatility at these higher prices. As things are more expensive, there's a more likelihood they could go on sale at some point, right, as a way to put it. And so balance is key. It's great to be dialed in with your portfolio as we do with clients. If you ever have concerns or items you want to cover, do not hesitate to contact us. And so bringing it all together as we look at key takeaways, these are absolutely uncertain times. They're uncomfortable times. Nobody knows where we're going to land on tariffs, what the impact will be. And therefore, we need an all-weather strategy to handle no matter what's thrown at us. And even with the recent stock market correction, we're not necessarily out of the woods, right? This can be a volatile year. That doesn't necessarily mean the market will just go down, but especially as prices remain modestly elevated, we're likely going to see a lot of up and down throughout. So again, try to minimize media exposure, stick with the plan, call us if you ever have worries, but it's probably going to just be one of those keep the seatbelt on years. And it's likely to be some bumps along the way. Key time for balance. Bonds can be less volatility to a portfolio. We've seen international equities do well. Real assets have done tremendously well. That's a key component of our portfolios for clients. And so again, a well-diversified portfolio is designed to get through these periods as we strive to do for clients. And market declines are just part of the investment experience. Price of admission, control what we can control is the main keys. So again, we're focused on maintaining a long-term focus, well-devised portfolio, personalized to your need and situation. Do not hesitate to call us with any questions or concerns you may have. We appreciate you for having trust in us, and we are here and we'll keep the communications coming. I do want to note that this is a critical time to be invested the right way. And commonly, we do see folks that have the wrong amount of risk, have the wrong amount of exposures in our view. And so it is an important time to do a health check, look at your portfolio, look at your retirement picture, make sure everything's in line. At the same token, if you have colleagues, friends, people you care about, especially those that are nearing retirement or retirement, likewise, there's a possibility that they do not have the right amount of balance. And so that's a great time. We'd be happy if you want to introduce us to talk to and have those consultations with anybody you care about. And so again, feel free to let us know if you have somebody in mind you'd like added to our communications, or likewise if you have somebody in mind that you think would benefit for meeting with us. And we'd love to talk to them. A great way to get in touch is you can go to our website, stablerwealthmanagement.com. There's that Let's Talk button, the big orange button on the top right of the screen. And so absolutely feel free to direct people to us there. You can make an introduction email. But yep, anybody you care about, we'd love to sit down with them and provide some feedback and see where we can help out. Thank you again for taking the time to join us. We appreciate you, and do not hesitate to reach out if you have any questions. And we look forward to talking with you soon. Take care.